Beni, se você já quiser começar, a palavra é toda sua.
Obrigado, Maria. Boa noite a todos. Hoje é um prazer estar com Howard Marks, sócio fundador da Oaktree. Hoje o evento vai ser em inglês, com tradução simultânea para quem estiver no Zoom e assim desejar. Good night, Howard. Actually, good afternoon because you're in LA, right?
And good night to you, Benny, or maybe I will say bom dia.
Great, thank you so much. It is a great pleasure to have Howard Marks here with us tonight. Howard is the founder of Oaktree Capital Management and manages more than $135 billion. He had wrote two of the most important books in the financial markets, one that's called The Most Important Thing and the other Understanding Market Cycles. Both books most recommended for investment professionals around the world. Warren Buffett says that when he sees Howard memos that are very well known in the financial market in his email box, the first thing he does is to read it. The last time that I've been, today with us, we have Elisa Pepper, our CIO at XP Advisory in US. She's based in New York. We have Bettina Rocho, which is our equity strategist in XP Investimentos, and Guilherme Anversa, which is a portfolio manager at XP Advisory, working with us here in the private banking side. And myself, my name is Benny. I'm heading the private banking division here at XP Investment. Howard, we've been together 2 years ago in São Paulo, and I remember asking you where in the cycle we were, and you answer me using a baseball idea that we were in the 8th inning. So for Brazilians that doesn't follow too much baseball, it's pretty much saying that we are in almost at the end of a soccer match, the last 15 minutes maybe. And you also said we are in the 8th inning, but I don't know how many innings we have. That again, comparing to Brazil, is we don't have if we're gonna have extra time in the soccer match. So my first question to you is, the cycle completely changed, and where we are right now?
Well, Benny, normally the cycles are in the market are the result of economic changes and changes in the business world. But of course, today, unfortunately, our cycle change is caused by a unique influence, which is the coronavirus. We have seen a very rapid deceleration of economies all over the world. Nothing like this has ever been seen before. The example that I use, and I hope this one translates, is that when people are very ill, the doctors sometimes put them into a coma in order to cure the disease. This time, we have the disease, which is coronavirus. We have to stop its spread. So the way they've done that is by telling everybody to stay home, which is to say, to not participate in the economy. So workers can't go to work, citizens can't go to shop, or to the movies or to the sports activities. And the Fed and the Treasury will provide life support to keep the economy alive as long as it has to be in the coma. The hope is that the disease will be cured, the coma will be brought to an end, and the patient can be brought back to life.
Howard, in your last memo, you have mentioned that the impact on individuals and the economy will be painful. What are your thoughts about the solutions to reduce this impact? And on economics specifically, we have seen lots of measures announced, but do you think there is a need for the Federal Reserve to deliver more? If so, what else could be done?
Well, I mean, when we say we'll need more, the main thing is that the citizens will need more support. The family of four has been allocated $3,400. $3,400 for a family of four is right around, I think, around the poverty wage. So the citizens won't be able to live on $3,400 very long. When I say the poverty wage, I mean the monthly wage. So $3,400 is enough to live this month, but I think that they'll need another $3,400 next month and so forth. And, you know, the question really is, will the government keep giving the support? I assume they will. The Fed and the Treasury have indicated that they'll do everything they can think of to support the economy. And then the next question is, will there be any negative effects from all this flooding of money? But in the meantime, I think we'll see continued allocations of support.
Lisa, you have to unmute yours.
It is unmute. It is. Can you hear me?
Yeah.
Okay, sorry. You mentioned in your last letter that the emotional selling allows us to access the greatest bargains. Double question. One, are you finding bargains now? And if so, are you already deploying capital at this point?
Well, we started to deploy capital about a month ago, and we deployed a good amount in the first weeks of March. And in fact, we were accessing assets at what we thought were irrationally low prices. There was panic selling, margin calls, liquidations, mutual fund redemptions, and people who wanted to raise cash to make themselves feel more comfortable. It slowed down last Tuesday when the government committed to its actions. Now we have continued to invest, but not as much, because the things that I listed before have not been present: the panic selling, the redemptions, et cetera. So, you know, the lower the prices are, the more aggressively we buy. Right now, the supply of distressed assets has slowed down.
Are you focusing mostly on the distressed and stressed part of the credit spectrum?
Well, not really. I mean, that is, I think that's one of the things we're best known for. And of course, that's where we normally can access the best bargains and the highest returns. But of course, it's a risk strategy. Some of our clients want to access our lower risk strategies of just performing debt and earn high yield. And you know, high yield bonds, which were good high yield bonds without energy, which 6 weeks ago were yielding about 3 and change %, are now yielding close to 10. So a lot of people will invest there to try to get the 10. Then we have intermediate strategies, which take on more uncertainty for more return. And then ultimately we have the distressed debt funds, which, you know, Bruce Karsh, my partner, and I have been managing distressed debt funds since 1988. And in those 32 years, we've had 3 crises so far, 1991, 0102, and 08. And these were all very difficult periods. And the funds we formed in those periods all had a very significant double-digit returns. So if this turns into a full-blown crisis, if we get the panic selling and the defaults like we usually do, you know, in the distressed debt category, we'll be aiming for very high returns.
Do you expect that to be coming, you know, as we keep the paralyzations on, the longer we stay out of job? Okay.
Yes, you know, I mean, this is what we believe will happen. No, I'm not somebody who believes that he has a crystal ball and always knows the future. But, you know, we had let me say that in 3 weeks ago, we had 281,000 new claims for unemployment insurance. Mm-hmm. The week after, 211. The week after, 281,000 claims. And last week, 3.3 million claims. We think that the GDP and the profits of the S&P 500 companies will show the biggest declines in history in the second quarter. So I think there's a lot of pain out there waiting to take place. And these developments will produce a good amount of distress.
Got it.
Howard, my question is about crisis. You have mentioned about 3 crises that you have experienced over the last 30 years. Have you seen in history a similar crisis to what we are going through? And what are the lessons that you have learned from this period?
Well, as I say, we've lived through 3 crises. We've earned very high returns. I think the most important lesson is that the big money and the easy money in investing is made by doing the things that other people don't want to do, that other people are afraid to do and unwilling to do. And, you know, usually that includes investing during a period of distress. So, you know, if we get the opportunities, I'm confident that we'll seize them. I hope we'll make good selections. And if that's the case, then the lesson says that we should earn high returns.
It's me again. Hi, sorry. Going back to the economy as a whole, do you believe what do you think about modern monetary theory, and do you believe there is a limit to government debt? And I will have a second follow-up on that after this.
Sure. Elisa, thank you for that question. You know, Elisa's reference to modern monetary theory is to a view that has been developed over the last year or two, or become popular over the last year or two, which basically says that government deficits and debts don't matter. And that if you have a currency as strong as the US dollar, you can spend as much money as you want, you can run as big a deficit as you want, and it doesn't matter. Personally, I find that hard to believe. I grew up in a period when we actually used to debate whether it was okay for governments to have debt. And now, not only do they all have debt, but now we're hearing that it's okay to have unlimited debt. And, you know, I have trouble believing that, although, you know, the answer on that is we'll see.
And so for those that are not lucky to print to issue debt in their own currency, right?
Yes.
They already had a lot of deficits already, fiscal deficits, and that's going to get much worse going forward. How do you view that, especially when you take into consideration your investments? If you're investing in emerging markets or other governments that may be printing or issuing a lot of debt to cover for the costs of this pandemic?
Well, you know, the truth is that historically, distressed debt has been the best way to take advantage of other people's difficulties. And in the emerging markets, for example, in recent years, it's been easy for companies to issue debt denominated in dollars, but they don't do business in dollars, and they're going to have difficulty coming up with the dollars to pay off their debt. So, many of the companies that we're investing in on the emerging market side of our business will have difficulty paying their dollar-denominated debt, and but if they work it out in the long run, I think we'll buy it at low prices and get a good return.
Okay. Thank you.
Okay, so comparing again this time to other crises, former Fed Chairman Mr. Ben Bernanke said that this crisis resembles more the impact of a natural disaster than a traditional financial crisis similar to the one we faced in 2008. And therefore, we should have a deep, but hopefully quick recession. Do you agree with this assessment?
So he said a natural disaster.
Yeah, such
Yes.
as hurricanes, for example.
Yes. Well, number one, the hurricane, when it's passed, number one, the big difference is that it passes quickly. And the hurricane is over in a day or a week. And this one, I've been in my house for 2.5 weeks. And I believe I'll be here at least another month and maybe 2. So this is not going to pass so quickly. Some people have made the comparison to 9/11. And again, that was a one-time phenomenon. Of course, we were afraid of more, but it didn't develop. Number 2, that one, the ones in the past were, when they were over, they were largely financial. This one actually threatens people's lives. And so I don't think it's going to be over and forgotten so quickly. In every other crisis that I've participated in, whether it was as I say, 9/11, where we were closed for a few days, or the global financial crisis, which threatened the financial system for a few months. In each one, we quickly got back to normal in terms of the operation of the economy. And the stores were open, and people continued to have their jobs and so on. And I'm afraid that this one is very different because the jobs may disappear because the companies do so badly, or the people will not be able to go out and do business. Another thing which I worry about is, that the government will distribute money to take the place of the wages of the workers and the revenues of the businesses. But we actually need the things that businesses create. Where does food come from? The big topic of conversation, of course, is toilet paper. Where does that come from? We need factories to be in operation so that we can get the necessities of life. And it's not sufficient to merely give people money. So I think there are always similarities, but there are also differences.
Howard, my question is, here in Brazil, for the first time, we have very low interest rates, and Brazilian investors are adding more risky assets in their portfolio. So what is the most important thing that an investor can do to achieve long-term returns?
Well, I think, I think, Benny, that we have to be conscious of risk. I talk about risk more than anything else in my books, as you know, and, the secret to long-term investment success is not an occasional home run, or maybe in soccer terms, an occasional goal, but it's long-run defense, being aware of the risks you're taking and taking risk only wisely. And I think that, since the time when I saw you 2 years ago, the question was, did you go into this episode with the risk under control in your portfolio or with high risk? And, this is what will determine investment success. Warren Buffett says, it's only when the tide goes out that we find out who's been swimming without a bathing suit. So we will find out in the near future which investors controlled the risk in their portfolios and for which investors it was out of control.
Howard, we have more than 7,000 people watching us right now between Zoom and YouTube. And several of them already made some questions here. And I'm also, it's open to questions. So anyone that wants to do a question, please go for it. But
well, Benny, I'd just like to say that I knew that XP had a broad reach in Brazil, but I didn't know you would reach 7,000. So congratulations.
Thank you so much. Thank you so much. But I will try to choose some questions here. Maybe you cover partly in your answers already, but I'll try to follow some of them that I think weren't covered totally. So there's a question here from Renato. Howard, what do you think about the consequence of this money rain?
Well, I mean, first of all, Renato, I try not to come up with very strong opinions with regard to things we've never seen before. And nobody knows the answer to your question, including me. Having said that, of course, our concern is that a period of what you call money rain, and I like that term, will lead to a period of hyperinflation and lower value for the dollar. And I think this is a great concern, especially at a time like now when the world's productive system is constrained. So when the world economy can't produce everything that people want to buy, we call that a supply shock. And when we have a supply shock and money rain, I think there is the possibility of an increase in inflation.
Thank you. Another question here from Enrico Canazart. Howard, in what sectors are you seeing the main opportunities in the distressed debt space?
Of course, Enrico, the biggest price declines are always in the areas that have the worst outlook. So there's nothing worse today than oil. And, oil today hit $19 a barrel, which is practically the lowest it's ever been since the OPEC embargo of 1973. And by the way, $19 a barrel, it means it's almost back to where it was before OPEC put on its embargo and forced the price up. Just think about the fact that in 2015, the price of oil was 110. And in, I believe, July of 2007, it was 150. and now it's 19. So, oil companies are going to have a very hard time staying in business, paying their bills, and servicing their debt. So a large part of the oil industry is in distress or will go into distress. Beyond that, and by the way, nobody knows the outlook for oil. One thing I should mention is that when the economic activity of the world contracts, as it is, people consume less oil. And of course, that contributes to a decline in the price, in addition to the price war, which is going on between Saudi Arabia and Russia. And so the outlook for oil is very bad. So what that means is everybody says, well, that's it. I want to get out of any debt of any company that is related to oil. And while that's understandable, if they sell that debt too cheaply or too aggressively or too urgently, maybe it'll become a bargain for people like us. Another area is cruise ships. The cruise ships had very bad experience having people on board when the virus broke out. So now everybody says, well, that's it. Nobody will ever take a ride on a cruise ship again. But, I'll bet they will. One of these days it'll come back. And then the other thing, so those are the areas that have suffered the most. The other thing to think about is that there are actually areas where, like everything else, they've sold down, but where they will come back. And the optimists think that in 2021, the economy will recover and GDP in the US will exceed 2019. And maybe, but also maybe not. But the point is, it might take till 21, or it might take until 22, but the economy will come back. And we're able to find companies where we're highly confident that they'll stay in business and the debt will be what we call money good. And so we're happy to buy those debts today.
Howard, another question here that I think it's really interesting from Jose Bosco. Jose, I know it may be too early to speculate, but in your mind, what do you think fundamentally will change in business, and which businesses models will succeed in the next 2 to 3 years?
Before I answer your question, Jose, let me say that most people say, well, which businesses will do well, and then they invest in them. The real question is, which ones will do well, and people haven't quite figured it out yet. We want to invest in things where the advantages are not understood generally. Having said that, every time I leave my house to go visit Brazil to see XP, my wife says, why are you going? Why don't you just make a phone call? And so I believe that now, I'm not saying that nobody will ever travel for business anymore. My guess is a year or two from now, the business travel activity will be back to 75% or 80% of what it was last year. But that's 20 or 25% less. So my guess is that everything else being equal, the business for airlines will be diminished. The business for hotels will be diminished. Now we're talking today on Zoom. I think Zoom just got a bonus. And now everybody understands that doing business by Zoom is a great idea and that Zoom is a great business model. So, these are the most obvious ideas. But the difficult ones will still be energy, for example, where the future is far from clear.
There's a question that's correlated to the other one from an anonymous attendee. What do you think that is the biggest cultural change that will happen after this crisis?
Well, that's a great question. I haven't had time to really think about that too much, but I think, for example, well, in our country, I think the pagan custom of shaking hands may decline. On the other hand, when I travel in Latin America, I'm shocked to see that everybody kisses. And when I go into a business office in Latin America, very often the people I go with kiss the receptionist and so forth. And I would guess that we won't see quite so much kissing in the future. But I mean, that's a pretty obvious one, but who knows?
Guilherme, Bettina, and Elisa, please join me as well. If you find any question that it's interesting to do, I will do another one, but I will welcome to you guys to choose some of those questions. Now we have more than 50 questions already. Another question here that is connected to credit. Should we be prepared for a bigger credit event or policy measure? Should we be prepared for bigger credit events or policy measures by the government than we already have?
Well, as I say, I don't think that what's been declared already is going to be sufficient to keep the economy afloat and all the workers who lost their jobs in good shape. So I think we'll see more. And the Fed has already said that they're going to use what they call their whole toolbox. All the tools they can think of are going to be employed. My guess is that there is nothing which is off limits. There's nothing where the Fed will say, no, that we're not doing. So yes, I think so.
Another credit question here, Benny, from Michelle, from our Q&A list. He asks for Howard, do you think that this time, differently from 2008, banks are better capitalized and can also play a role in helping companies out of this crisis?
Yes, well, the great advantage this time, or I might say the great disadvantage last time, is that the good performance of the economy from really 82 and the increasing worship at the altar of capitalism caused the banks to lever up last time to the point where their debts were roughly 32 times their equity. And leverage makes life very dangerous. And that's why the banks got into big trouble last time, because they had heavy investments in the subprime mortgage securities, which went bad. And they jeopardized a large percentage of their equity in that way. This time, the banks are less leveraged. And maybe most banks are 11 or 12 times their equity. And so the banks are much safer. There has been lots of risky lending done, and much of that was done by non-bank lenders and leveraged investment vehicles. So that's where the pain will occur this time. Anybody who took on, the capital markets were extremely generous for the last 5 to 7 years. And, companies could borrow large amounts of money very cheaply, and that encouraged them to do so. And everybody who has heavy debt and declining revenues will be in a jam, and that will be quite widespread. The government will try to make it up. As I say, the government will be issuing life support, and the question will be whether its activities will be adequate.
Howard, I have some questions about the global economy in general. What indicators should we be aware of, and what indicators can show that the crisis is bigger than we expect?
Well, the main ones, things like, I would say GDP. You know, what will GDP be in the second quarter? The estimates are very varied. And the earnings of the S&P 500 companies, you know, these are 500 of the leading companies in America. And I have seen estimates ranging from that their profits will decline 10 or 20% to the profits will be down 120%. Now, what does it mean for profits to decline 120%? It means that they go from making money to losing money. And the thought that the 500 companies collectively could have a loss is quite shocking. Nobody knows how to project these things since there are so many moving parts, and we've never been in this, you know, in this part of the world before. We're what the Latins would call terra incognita, land that nobody has ever known. And so these will be some of the indicators, but of course, when the declines in GDP and S&P earnings are announced, it'll already be too late to do anything about it.
Howard, and sorry, Danny. So there's another question here, also linked a little bit to this previous question. So how to manage risk in such a volatile and uncertain scenario?
Well, you know, the higher quality instruments you hold now, the less uncertain your future will be. That's always true, and it's especially true now. Having said that, in a way, it's too late to measure risk. You know, you have to take driving lessons, decide to drive carefully, stay away from the bars, and so forth before the accident. Once the accident has taken place, then it's too late to become a safe driver. So I think that's pretty much the truth now. The accident has taken place. The risk of the virus or the risk of something bad happening has occurred, and it's kind of, in a way, too late to cut your risk now, I think. Well, maybe not, but the point is a lot of the damage has already been done. And while I'm on that question, I'd just like to mention one thing. Benny mentioned the fact that I came to see him 2 years ago. And I told him that I thought we were in the 8th inning. That is near the end of the game. And that it was time to cut risk and that it was time to take a careful approach. But I'm confident that I never said to Benny, I think there'll be a coronavirus, or I think there'll be a health problem, or even I think there will be a depression. What I'm getting at here is that we never know what's going to happen. And I certainly did not know 2 years ago. The only thing I did know was that the world was exposed to risk because asset prices were high and people had been engaging in risky behavior, and companies and countries had levered up. That is to say, taken on more and more borrowed money. So that's really the lesson in risk control. You don't have to know what's going to happen in order to understand when it's important to behave in a safer way.
Elisa, I don't know if you wanna ask something. You're on mute, Elisa. Yeah.
All right. Okay, I'm here. Okay, got it. One question is related to the deleveraging that occurred during the May panic selling, and much of it coming from funds that are quantitative or risk parity funds. What do you think about this dynamic that makes it everything correlates so far so fast when there is a big event like this?
Yeah, that's a great question, Lisa, and it's one that's very interesting for me to answer. You know, there are certain, when we manage money, there are certain principles that we employ for guidance. You know, if you think about each of us, when we walk across the street, we assume that the cars will stop if they face a red light. You know, when we go into a restaurant and we order a meal, we assume that they'll feed us food which is safe and healthy. So we live our lives by making assumptions. And we assume a continuation of normalcy. Now, so number one, we assume that even if we invest in risky assets, our risk will be limited if we diversify our portfolios, because some things will go up and some will go down and some will go sideways. But there's an old saying, which your question hinted at. In times of crisis, all correlations go to one. That is to say, everything performs terribly at the same time. And that's what we saw in the past weeks, leading up to the day of the government stimulus, which was the 24th of March. So, you know, people who engaged in risky behavior thought that they had some safety on their sides because their portfolios were diversified. Everything got hit at the same time. The other thing is this: when we engage, you mentioned quantitative, algorithmic type investing, or maybe what's called risk parity, which is another form of mathematical investing. When people engage in these kinds of quantitatively driven investments, they build a model of the future. Everything is oriented to the future. And if you're going to try to put together a portfolio that will perform well in most environments and not too badly in the bad environments, you have to have a view of the future. You have to have a model. And the way we build models is we assume something called the probability distribution. What will next year look like? Well, most probably this, a little chance of that, some chance of this, not much chance of that, and that probably can't happen. So we build a probability distribution. Usually it's in the shape of a bell-shaped curve that is supposed to describe the future, and it's based on what has happened in the past. And basically, this month or last month with the coronavirus, something happened which is not supposed to happen and which almost never does happen. You know, the greatest pandemic of the Spanish influenza was 1918, 102 years ago. So these things rarely happen, and the people who invest can't build their portfolios on the assumption that they will happen, because then they'll never make any investments. So you have to assume that these terrible pandemics will happen very rarely, if at all. And then once in a while they do happen. And that's why, you know, some of these techniques like algorithmic investing and risk parity didn't work in the crisis. Number one, the diversification benefits weren't there. And number two, something that rarely happens did happen.
Howard, I'm receiving like questions everywhere, like my WhatsApp, my Instagram, LinkedIn. People are sending questions to make sure that I can make it for you. But I have three questions here that I would like to do. One from Jonathan Skurnik, which is in London right now. He asked, how have you adjusted your baseline assumptions when reviewing investments opportunities in this so uncertain scenario?
Well, I think the main thing is that we demand higher returns. 6 weeks ago, the yield on high yield bonds was in the 3% region, 3 to 4%. Investors might take on some risk in order to access that. Now, with the uncertainty provided by the coronavirus, we would demand much higher returns to take the same risk and shoot for safer companies that we're confident will be healthy and in business 2 years from now. So I think that, this is a time when you have to be careful and raise your standards. But on the other hand, this is a time when risk taking is much more rewarded. The reason that I cautioned Benny 2 years ago is because people were taking risk without the chance of adequate reward. Now I think the reward for taking risk is much higher. So if we can find companies that we think will be in business 2 years from now, and if their debt is depressed in price, we will buy it.
There's several questions here, like different type of questions about Brazil. And one mentioned that your company just merged with Brookfield. And Brookfield invests in Brazil for more than 100 years. And there are like different type of questions about what do you think the investment scenario in Brazil is it right now? And we had a Zoom this weekend with Paulo Guedes, our finance minister, and he said that Brazil, it's in a different point of the cycle than the rest of the world. So do you agree with that scenario? What do you think have opportunities in Brazil, infrastructure, or different type of opportunities in Brazil by any chance?
Well, look, first of all, let me say, Benny, before anybody takes me too seriously, that I'm not an expert in Brazil, and I don't claim to be. Oaktree and Brookfield both may invest in Brazil, but we have experts who do that, not me. Secondly, of course, there are things that matter in Brazil that don't matter as equally in other parts of the world, and vice versa. So Brazil has the wonderful condition of enormous physical resources. And, we continue to be attracted by those resources. If Brazil gets competent management by the politicians, then I think Brazil will do well. Those are, and these are the important questions to answer with regard to the long-term future of Brazil. I hope that you don't encounter the same short-term problems with the virus that the rest of the world is having. So, I think the answer to the Zoom you mentioned is correct. There are things that matter in Brazil that don't matter equally in the rest of the world, and vice versa. And I'm hopeful that Brazil will have good fortune.
Howard, I have a question here on second level thoughts, which is a first level thought is that this crisis is going to affect business in the short term, and the intrinsic value of most companies have indeed deteriorated. What are your second level thoughts on this crisis, and what do you think investors are missing?
Well, believe it or not, Bettina, right now, the stock market, after the government announced its activities, did you know that on Tuesday, Wednesday, Thursday in the US, it was the best 3 days since the 1930s. So I think that investors are assuming that the government actions will work. And I think that the second level thinker is not so confident. That's the main thing. I think that we're still heading into a big problem period, and I still don't want to make positive assumptions.
So if I may add one more question here. The most important thing, changing a little bit the subject, but the most important thing is the most recommended book by the guests of Stock Pickers, which is the most popular podcast about financial markets in Brazil and is made by XP. So what book do you recommend besides yours?
Well, first of all, I'm very glad to hear that and proud of it. And of course, my book has the advantage of being available in Portuguese. The most important thing. I really like a book called Fooled by Randomness by Taleb, Fooled by Randomness, because it talks to people about how to think about uncertainty. And a great deal of my concentration is on the subject of thinking about uncertainty. One of my heroes, John Kenneth Galbraith, was an American economist of the 20th century who wrote a book called A Short History of Financial Euphoria. And I think that's a very useful book in how to think about cycles and the extremes of psychology. And I think that, you know, I pay a lot of attention to psychology, and I try to understand the psychology that is in the market, and most of the time do the opposite. So I think those are two examples of wonderful books.
Howard, there's another question related to this one. What's the book you are reading right now?
Well, I'm actually reading a light-hearted book, which I think that in times like this, it maybe, sorry. In times like this, I think it's a good idea to read something light, not get too depressed, and you know, there's plenty to think about during the workday about investments. I don't want to read about investments at night also.
Good. There's a question here from Pedro Fiuza. Howard, do you think this crisis will change the way people invest? If so, how? How so?
The normal thing that has happened in the past, and the thing I assume will happen this time, is that when we go through a crisis, people lose a lot of money. They get depressed because they made risky investments that failed. And so they say, that's it. I'm never going to take risk again. I'm going to be very careful and very prudent and avoid risk in the future. And then what happens is when the market comes back, the people who stayed in the market, who got into the market, make a lot of money. And the person who said, no, I'm never going to take risk again, he has to look on with envy as other people make money. And eventually his appetite for risk bearing comes back. Now, I think that the coronavirus is probably the worst thing that has happened to the world in 80, 90, or 100 years. And so I think that the risk-taking behavior will decline, and then it will come back slower. But it'll come back eventually because that's human nature.
Howard, to be within our time, I would like to make the last question, which I think it's very interesting, and probably you have heard that before in different crises or in different moments, but Américo Pereira from Miami has asked, given the nature of this crisis, are you thinking about to rewrite your books? Do you have new learnings?
You know, I don't want to sound smug, Benny, but I think that the books have discussed how to prepare for a moment like this. And I think that if somebody read the book on cycles, which came out a year and a half ago, they would have known that at a time when markets are high and people are optimistic and behavior is risky and prospective returns are low, that's the time to move to safety. And I believe that people who read the book would have moved to safety, in which case they've probably done better than others. So, you know, I must say, I think the books had it roughly right. And, you know, we're always learning, but I can't say that the books have to be rewritten. So I want to thank you for having me on this broadcast today and putting me into contact with so many people. And I hope that some will conclude that the things we do can find a place in their lives.
Great, Howard. Thank you so much for your time. I hope to see you again, not only at Zoom, but also in person. So it would be great to meet you
Very good.
here again. So our doors are always open for you.
Thank you, Benny. Nice of you to have me on, and I look forward to that date.
Thank you so much, Howard.
Bye-bye, Bettina, everybody. Thank you all, for all the people of XP. Thank you.
Thank you.
Okay.
Bye-bye.
Bye.